The coming silver tsunami. How pension funds and 401ks will drive SLV to historic heights. What if I told you that the biggest money managers in the world are about to make a move that could send silver prices soaring? Not retail investors, not speculators, but the massive pension funds and 401k managers controlling trillions of dollars. Here's what most people don't understand. While silver just had one of its most explosive years in history, climbing from under $30 to over $67 per ounce in 2025, institutional investors barely participated. Pension funds and retirement accounts sat on the sidelines. They watched, they waited, and now they're dramatically underweight in one of the best performing assets of the year. But that's about to change in a massive way. In this video, we're going to explore exactly why pension funds and 401k managers are preparing to flood billions of dollars into the silver market. We'll look at the new regulatory changes coming in 2026 that break down barriers preventing these institutional giants from investing in precious metals. We'll examine why they can't buy physical silver like retail investors do, which means all that money flows into exchange-traded funds like SLV. And we'll calculate just how explosive this could be when trillions of dollars under management start chasing a relatively small market. This isn't speculation. This isn't a Reddit conspiracy theory. This is about following the money trail and understanding the mechanics of how the largest pools of capital in the world operate. By the end of this video, you'll understand why some analysts believe we're standing at the edge of the most significant institutional silver buying wave in modern history. Let's dive in. Understanding the institutional gap. First, we need to understand just how underweight pension funds and 401ks are in silver right now. Think about this. Silver returned over 164% in the past year. That makes it one of the top performing assets across all categories. Better than most stocks, better than real estate, better than bonds, better than almost everything. Now, when institutional investors miss a massive rally like this, they face a serious problem. It's called career risk. Portfolio managers at pension funds don't just manage money. They manage expectations. They manage benchmarks. And when a major asset class explodes and they have zero exposure, they have some explaining to do. Here's the reality. Most pension funds have less than 1% exposure to precious metals. Many have zero. These are funds managing hundreds of billions, sometimes trillions of dollars. A typical pension fund might have 60% in stocks, 30% in bonds, and 10% spread across alternatives like real estate and commodities. But precious metals, barely a blip. This creates what financial analysts call mean reversion pressure. When an asset performs exceptionally well and institutional portfolios don't own it, there's enormous pressure to add exposure. Not because they're chasing returns, but because they need to rebalance their risk exposure and ensure they're not missing the next leg up. The numbers are staggering. American retirement accounts hold approximately $37 trillion. That's trillion with a T. Even if just 1% of that money shifted into silver-related investments, we're talking about $370 billion of buying pressure. But here's where it gets interesting. Institutional investors can't just go buy silver bars and store them in a vault. That's not how pension funds operate. Why institutions must use ETFs? Pension funds and 401k managers face strict fiduciary requirements. They need liquidity, they need transparency, they need regulatory compliance, they need daily pricing, they need custodial solutions that meet institutional standards. Physical silver doesn't check these boxes. Imagine a pension fund managing $50 billion trying to buy physical silver. Where do they store it? How do they insure it? How do they quickly liquidate if they need to rebalance? How do they provide daily valuations to their beneficiaries? These aren't small problems. These are deal breakers. This is exactly why exchange-traded funds like SLV exist. The iShares Silver Trust SLV holds physical silver in vaults, but investors don't need to worry about storage or insurance or security. They simply buy shares that represent ownership of that silver. The fund handles everything else. For institutional investors, SLV provides the perfect solution. It trades on the New York Stock Exchange just like a stock. It has deep liquidity with millions of shares trading daily. It provides transparent daily pricing. It meets all fiduciary standards. And most importantly, it's approved for inclusion in retirement accounts. When a 401k administrator decides to add precious metals exposure, they're not calling up a bullion dealer. They're adding SLV or similar ETFs to their platform. When a pension fund wants silver exposure, they're buying SLV through their institutional broker. This creates a critical dynamic. All that institutional money flows through a relatively concentrated funnel, and that funnel is precious metals ETFs. Now, you might think SLV is already huge. After all, it holds over 500 million ounces of silver. That's a lot of metal, but compared to the potential institutional demand coming, it's actually quite small. The 2026 regulatory shift. Here's where the story gets really interesting. There's a massive regulatory change happening in 2026 that most people aren't paying attention to. For years, regulatory guidelines created an environment that effectively prevented fiduciaries from including precious metals in retirement plans. The rules weren't explicit bans. They were more subtle. They created so much compliance burden and legal uncertainty that most plan sponsors simply avoided precious metals altogether. But new federal directives are instructing regulators to rethink these rigid constraints. The government is creating what's called a safe harbor for plan sponsors who include precious metals. Essentially, they're giving legal protection to 401k administrators who add gold and silver options to their investment menus. This might sound like a small technical change, but it's enormous. Think about it from a 401k plan sponsor's perspective. Before this change, adding precious metals meant potential legal liability. If silver prices dropped and participants lost money, the plan sponsor could face lawsuits. The regulatory ambiguity created too much risk. So they just didn't offer it. After 2026, that calculation flips. Now there's explicit regulatory approval. There's a safe harbor. The legal risk disappears. And suddenly, not offering precious metals might actually be the riskier choice, especially after silver's explosive performance. Conservative estimates suggest that if only half of 401k assets end up in plans using these new rules, we could see $40 to $90 billion flow into gold and silver over several years. That's not a quick pop. That's a firm, persistent tailwind pushing prices higher year after year. After 2026, that calculation flips. Now there's explicit regulatory approval. There's a safe harbor. The legal risk disappears. And suddenly, not offering precious metals might actually be the riskier choice, especially after silver's explosive performance. Conservative estimates suggest that if only half of 401k assets end up in plans using these new rules, we could see $40 to $90 billion flow into gold and silver over several years. That's not a quick pop. That's a firm, persistent tailwind pushing prices higher year after year. But here's what those conservative estimates miss. They assume a slow, gradual adoption. They assume pension funds and 401ks will move cautiously. But what happens when the first movers start seeing outsized returns? What happens when institutional managers realize they're missing a major trend? The answer is simple. More money rushes in. The trickle becomes a flood. The math behind the explosion. Let's do some math to understand just how explosive this could be. Silver is a relatively small market. The total value of all silver ETFs globally is around $60 billion. That sounds big, but compared to other asset classes, it's tiny. The total stock market is worth over $100 trillion. The bond market is over $130 trillion. Even the gold ETF market is much larger than silver. Now remember those retirement accounts holding $37 trillion. If just half of 1% shifted to silver ETFs, that's $185 billion. That's more than triple the entire current size of all silver ETFs combined. But it gets more interesting when you understand how ETFs work. When investors buy shares of SLV, the fund must buy physical silver to back those shares. They can't just create shares out of thin air. For every new share issued, SLV needs to purchase and vault actual physical silver. This is what's called a creation mechanism. Here's where supply constraints matter. Global silver mine production is around 820 million ounces per year, but most of that goes to industrial uses. Solar panels need silver, electronics need silver, artificial intelligence hardware needs massive amounts of silver, electric vehicles need silver. The available supply for investment is much smaller than total production, and we're already seeing supply tightness. Some industry experts warn that the solar industry alone could demand 85 to 90% of known silver reserves by 2050 at current growth rates. When you combine limited available supply with massive incoming institutional demand, you get a classic supply-demand squeeze. And unlike retail investors who might sell when prices go up, institutional investors think in years and decades. They're not flipping for quick profits. They're rebalancing portfolios for long-term allocation. This creates sustained buying pressure that doesn't let up. The industrial demand multiplier. We can't talk about silver's future without addressing the elephant in the room: artificial intelligence. Elon Musk publicly stated, "This is not good. Silver is needed in many industrial processes." He wasn't being dramatic. He was highlighting a real manufacturing crisis. Every AI data center needs massive amounts of physical infrastructure. Servers, cooling systems, power distribution, solar arrays for energy, all of it requires silver, the most conductive non-precious metal. The metal you can't substitute without massive performance degradation. This is fundamentally different from gold. Gold is mostly a monetary metal and jewelry. Industrial demand for gold is relatively small. But silver, over 50% of silver demand comes from industrial applications, and that percentage is growing. Solar panel installations are accelerating globally. Electric vehicle adoption is accelerating. 5G infrastructure needs silver. 6G will need even more. The entire green energy transition is silver intensive. This creates a unique dynamic. Even without investment demand, industrial demand alone is putting upward pressure on prices. But when you add institutional investment demand on top of accelerating industrial demand, you get what some analysts call a demand multiplier effect. Think about what happens when pension funds start buying SLV in size. The ETF needs to purchase physical silver from the market, but industrial users are also trying to secure supply. Mining production can't increase overnight. New mines take years to develop. Existing mines are already running at capacity. The result? Prices have to rise, and they have to rise significantly to both ration available supply and incentivize new production. The China factor and global dynamics. We also need to talk about China, because what China does with silver could amplify everything we've discussed. In 2025, silver posted its strongest weekly gains since 1998, surging 18%. The catalyst? Announcements from Beijing about strategic commodity reserves and manufacturing initiatives. China is the world's largest consumer of silver. They're also the world's largest manufacturer of solar panels, electronics, and increasingly, electric vehicles. As China pushes its green energy agenda and technological advancement, their silver demand grows exponentially. But there's another angle. China's central bank has been accumulating gold reserves as part of de-dollarization efforts. They're diversifying away from U.S. treasuries. If they apply the same strategy to silver, either directly or by encouraging their massive sovereign wealth funds to add silver exposure, the market impact would be enormous. Chinese investors are also becoming more sophisticated about precious metals. The retail investment culture in China increasingly views silver as both an inflation hedge and an industrial play. When you combine government policy, industrial demand, and retail investment culture, China alone could absorb a significant portion of available silver supply. This matters for Western pension funds because it means they're not just competing with other American investors. They're competing with global demand. And that global demand is accelerating. Why traditional asset allocation is shifting. There's a deeper story here about why institutional investors are even considering silver in the first place. It's about the changing nature of risk. For decades, the traditional 60-40 portfolio worked beautifully. 60% stocks, 40% bonds. When stocks went down, bonds went up. Perfect negative correlation, perfect balance. But that relationship broke. In 2022, stocks and bonds both declined together. The traditional diversification benefit disappeared. This sent shockwaves through institutional investment committees everywhere. Portfolio managers started asking hard questions. If stocks and bonds can decline together, what actually provides diversification? What protects against inflation? What protects against currency debasement when governments are running massive deficits? The answer increasingly is real assets, commodities, precious metals, things with intrinsic value that can't be printed or created by central banks. Silver sits at a unique intersection. It's a precious metal like gold, providing inflation protection and monetary value. But it's also an industrial metal with genuine supply-demand fundamentals. This dual nature makes it particularly attractive in today's uncertain environment. Pension funds managing retirement money for millions of people can't afford another surprise like 2022. They need true diversification. They need assets that zig when everything else zags, and silver increasingly checks that box. The timing convergence. What makes this moment particularly significant is the convergence of multiple factors hitting at the same time. Factor 1. Regulatory changes in 2026 removing barriers to precious metals in retirement accounts. Factor 2. Pension funds dramatically underweight after silver's massive 2025 rally. Factor 3. Accelerating industrial demand from AI infrastructure and green energy. Factor 4. Supply constraints with limited ability to quickly increase production. Factor 5. A changing macro environment where traditional diversification strategies aren't working. When you get this many factors aligning simultaneously, you often get what market analysts call a regime change. Not just a price move, but a fundamental shift in how an asset is perceived and valued. We saw regime changes with technology stocks in the late 1990s. We saw it with real estate in the mid-2000s. We saw it with cryptocurrencies in 2021. Each time, there was a period where institutional adoption accelerated rapidly, driving prices far higher than most expected. The difference with silver is that it's not a speculative asset with no intrinsic value. It's not a bubble waiting to pop. It's a physical commodity with genuine industrial demand, limited supply, and growing institutional recognition as a portfolio diversifier. What this means for SLV. So what does all this mean for the iShares Silver Trust, ticker SLV? SLV is the largest and most liquid silver ETF in the world. It has over 500 million ounces of physical silver in vaults. It trades with tight bid-ask spreads. It has institutional-grade custody arrangements. It's the default choice for institutional silver exposure. When pension funds and 401k plans add silver to their investment menus, SLV is what they're adding. Not physical silver, not smaller ETFs with less liquidity. SLV. This creates a concentration dynamic. All that institutional flow funnels through one primary vehicle, and when you concentrate billions of dollars of buying pressure into a single ETF tracking a supply-constrained physical commodity, prices don't adjust gradually. They adjust sharply. We've seen this movie before with gold ETFs in the 2000s. As institutional adoption grew, gold ETFs like GLD became massive. The fund had to continuously buy physical gold to back new shares. That sustained buying pressure helped drive gold from around $300 an ounce to over $1,900 at its peak. Silver is starting from a much smaller base. The percentage moves could be even more dramatic. And unlike the 2000s when it was primarily about monetary policy and inflation fears, this time we have the added catalyst of genuine industrial demand growth. The setup is remarkable, and it's happening right now. Conclusion. Following the institutional money. Let's bring this all together. Pension funds and 401k managers control trillions of dollars. They're dramatically underweight silver after missing a historic rally in 2025. New regulations in 2026 are removing the barriers that kept them out. Industrial demand from AI and green energy is accelerating. Supply is constrained. And unlike retail investors, institutions can't buy physical metal. They must use ETFs. All of this points to one conclusion. A massive wave of institutional buying is coming to silver ETFs, primarily SLV. And when that wave hits, the price impact could be explosive. This isn't about speculation or hoping for a squeeze. This is about understanding how large pools of capital operate and where they must flow given regulatory changes and portfolio rebalancing needs. The smart money isn't asking if institutional adoption will happen. They're positioning for when it happens. And based on the timeline of regulatory changes and typical institutional decision-making processes, that when is rapidly approaching. Now, I'm not a financial advisor, and this isn't investment advice. Always do your own research and consult with qualified professionals before making investment decisions. But I am pointing out something that's happening in plain sight. The pieces are moving, the stage is set, and the institutional money is coming. The question isn't whether pension funds and 401ks will allocate to silver. The question is how fast that allocation happens and how dramatic the price response will be when trillions of dollars start chasing a relatively small, supply-constrained market through a concentrated funnel of ETFs like SLV. If you found this analysis valuable, make sure to like this video and subscribe to the channel. We'll continue tracking this story as it develops, because what's coming for silver and SLV could be one of the most significant market moves of the next few years. The institutional tsunami is building, and it's about to make waves.